Okay, I'm Tanya Beater. Welcome. And this is the second national conference in Women in Financial Mathematics. It's sponsored by IPAM. I'm going to talk about IPAM in just a minute. What I'd like to do right now is just introduce the organizers of the conference. It goes for 2 days. Today's the industry day. Monique Miller is one of the organizers. Rosemary Macedo is one of the organizers, so I thank them. I particularly thank Stacy Beggs. Is Stacy in here? No. And Tammy Wong, and also Jorge Balbas, who is the one of the directors here of the Institute, for all of their help, because these conferences do not happen without a lot of blood, sweat, and tears. So we thank all the speakers who you're going to meet over the course of today. I think you have their bios, and they'll be introducing themselves a little bit. When I met a number of you who I hadn't met before who are students, welcome. This conference is really to help you to determine where the exciting areas are in finance. I'm going to pose a bunch of questions. Also, we hope that you will ask a lot of questions, right? Because we're really here to help you and to share with you sort of what our journey's been and what the exciting areas are right now and where we see the rising opportunities and the contracting opportunities, because life changes. So we'll be talking a lot about that as we go through today. But it's really nice to see so many women in the field, certainly when a number of us who have been in the field for a lot of years started. Every conference like this maybe had the reverse picture you see here today. If there were as many women as we have men in the room, that was actually quite a lot of women at the conference. So, I mean, it had the one plus that there was never a line at the ladies' room. But other than that, it was really kind of, there weren't people to really talk to and ask questions. So that was one of our motivations in bringing this conference, is to give you that opportunity. And it's not just today. You can reach out beyond today to ask those questions. I also want to thank the sponsors who are shown with their logos there in the middle. Certainly also conferences like this can't take place without the sponsors. And so we certainly thank their financial support for today. So let me talk a little bit about IPAM. First of all, what I want to say is that while there's a number of us in the room, also this is being live streamed. There's a number of the financial engineering and mathematical finance programs around the country who have actually set up rooms to live stream today. So we'll also be taking questions for those of you who are live streaming and watching us through the internet. If you want to pose questions, you can do that through the chat. So we'll be monitoring those and putting those questions in as well over the course of today. So IPAM is the National Math Institute. It's sponsored by the National Science Foundation. There are very few of them around the country. This one was started in 2000, so it's not very old. But it certainly has done a lot in the time that it's been established. The mission is to promote interactions between math and other disciplines. So if you actually look at the IPAM website, you'll see that, for example, there's conferences coming up on the intersection of math and the energy world, on math and physics, on math and medicine. There are just an incredible number of wonderful conferences that have happened here. And this one is the intersection of math and finance today. So we're going to try to keep it to that. This is the industry day. Tomorrow's the academic day. Where's Shin? Shin is the organizer of the academic day, along with Talia, who unfortunately is ill, so won't be here tomorrow, but she certainly and Shin worked very hard on putting together the academic day, which is a very, for those of you able to stay for 2 days, we'll be looking at a lot of the research that's going on to support the financial area. So the events here go from 1 to 3 days. On site with boots on the ground, there's usually well over 1,000 people every year who come through IPAM to attend the conferences. And for those of you going into academia, perhaps you'll be able to come to one of the longer period conferences, which are very worthwhile. And in addition, it's technologically pretty advanced as far as the different conferences go, and so that's why we're able to invite so many people through the live streaming process. One thing I do want to note is that IPAM is a 100% recycle facility, so everything that you do today should go into one of the two bins, either the recycle bin or the compostable bin, because that's one of the things that the Institute prides itself on. So let me dig in a little bit and just say that one of our missions today for you is really to connect the past with the future of financial mathematics. And I just want to make a couple of comments on that because I think it's very powerful. First, let me ask a question to all of those who are working and practitioners in industry in the room. How many of you are doing something today that existed when you started your career in finance? So I'm posing this and saying that you see very few hands in the air, and it's important to note that you're going to learn a lot for those of you who are in programs, and you're going to learn a lot of tools, and you're going to come out and you're going to be at the top of your game in terms of what your skill set is and what you know in your respective fields. And having talked to a number of you already, and I haven't met all of you, I hope to do that over the course of the breaks and the lunch and the cocktail hour later today. But many of the things that you will need in your career and the things you will do in your career don't even exist today. And the world of finance is massively and rapidly changing, and it has for years. You know, when I actually started, and I'll really date myself here, I'm an old Fortran programmer. Most of you probably, you know, that's in the archaic history books of programming, right? But that was the state of the art when I was at university. And certainly in addition, you know, when we wanted to run a simulation, we did it on a Cray computer, which cost a gazillion dollars in those days. And we were lucky if we could get the simulation back 2 days after we started it. So you couldn't trade because, you know, you'd get the answer 2 days after the market traded. So it wasn't particularly useful, right? So I give you that just to say that I'm sure you also, when you are, you know, well into the third decade of your career, will have equal stories that you will share. When you stand at the front of a room with students. And one of the main messages, and I hope that today in the panels, everybody's going to talk about, you know, a little bit about how their careers evolved, but also just about this huge need to really be at the top of your game and to stay really connected with the things that are going on in the field. So with that said, I'll just say that again, no question is a bad question. We're going to have several opportunities today. The last session will not be live streamed. It'll be, you know, a doors closed discussion where you can ask any and all questions, whether it's about work-life balance, whether it's about you know, kind of being the only female on a team, if it's about how do I, you know, progress and really do a good job becoming successful, because you have a lot of successful role models here today. There'll be no, you know, no limits to any question you want to ask, and we'll put all the panelists who are able to sit up at the front of the room at that point there to answer these questions and tell you their experiences. So we'll leave that really for the lunch break and for the end of the day discussion. It's any and all career advice. If you're struggling with choice A versus choice B, we'll do what we can to try to give you some insights. So today we have some really interesting thematic areas. I'm going to talk just a minute about the here-to-stay roles of big data and machine learning, but we're also going to talk about what our predictions are for FinTech and asset management. You know, normally when we all do conferences, we talk about what our firms are doing, and we talk about what our current product offerings are, and we don't really spend a lot of time talking about what our product offerings are going to be in 5 years or trying to predict it, but we're going to do some of that for you today. In addition, we're going to talk about what's going on with just the whole industry of asset management. There's tremendous fee pressure on the industry, and one of the ways that's being addressed is by bringing in much, much more technology, which is a whole lot cheaper, and also, you know, arguably does a more systematic job at the work that it's doing. In the afternoon, we'll also talk about quantitative investing. We're going to take a look at what's going on in algorithmic trading, the role of big data. I personally think we're at a period of renaissance in terms of trading systems that we're building, so we'll talk a little bit about what's going on there. And then we'll talk about what's going on in some of the other new products and what's happening in areas like risk management and others where I suspect if we draw a line in the sand, which was one of the questions I posed to my colleagues on the last panel today, if you drew a line in the sand and you built the products the way you would if you started today versus being stuck with the stuff that we've already built and spent a fortune on, both in hardware, software, data storage, and other things, how different would the world look? And it's an important question to put in front of those of you entering the field, because I do think that we will do things very differently going forward. And people who keep that front and center, I think, will succeed, and those who don't are likely to find themselves in the past industrial revolution, sort of similar to being a buggy whip manufacturer when the car comes in. We are really at that type of point of change. I just wanted to spend 1 minute on the first conference that we had. We had some similar areas. I have to say, the hardest thing for this slide was I couldn't find one with a woman. There was only one, and all of the photo stock of math pictures, they all had guys, but I did finally find one to put up here. We talked a lot about quantitative trading. We had predictions last time on FinTech and asset management. I'm going to get to some of those in a minute. We talked about portfolio allocation. One of the topics that was very popular last year that we don't have on this year's panel, but I just wanted to highlight for a minute, was how to communicate in math. And I have to say that that's something that, while we don't have a discussion today, you will in your careers have to translate complex mathematical notions into English for people who are not mathematicians. You will not be able to have the luxury of going into a room, picking up the piece of chalk, and immediately digging in with the formulas. So this is another place where, if we can be of help talking that through and ways that you can gain skills in that area, that will really set apart your success. If you want to go into industry. It's very difficult in industry to be successful in the long run if you can't translate the math into English and if you can't communicate well. So today we don't have a panel of that and of all the war stories that were just wonderful that people told last year, but we certainly can take that up as part of one of the lunch or the end of the day sessions. So I encourage you, if you have questions in those areas, to bring it up. And so we also talked a little bit about data analytics. I think what was distinctive when we had this conference about 18 months ago was that we really, at that point, didn't have, the big data, artificial intelligence taking hold as it has today in the finance world. So let me just say a little bit about who's on your panels today. So you have people who were trained in mathematics, both pure and applied, in finance, degrees in finance, in financial engineering, people who were trained in physics, in biophysics, in economics, in operations research, and engineering. A number of these people, if you're in the room and you're sort of in an academic profession now and thinking of crossing over into finance, a number of them successfully did that. Having been professors early in their career and working at academic institutions. A number of people today, I include myself in that, teach, but do that sort of on an adjunct basis alongside a full-time professional career. So there's lots of different models that people have followed. So if you have questions on how to make one of those transitions or do that, we're here to discuss that with you as well. We have people from banks, from startups, from data scientist operations, from people who build portfolios, who design new risk products. So a lot of different perspectives across everything from insurance to hedge funds to fund-to-funds managers to people who do portfolio allocation, investing, and just provide actually data and tools now to include in finance. So let me just say, I'm going to throw out some of the questions. These all really came out as part of the discussions that the panels had, which were actually quite a lot of fun. I enjoyed those calls tremendously myself. And I tried to group them into how, what, where, and why for you. And just to say that if there are some of these that really hit home for people in the room, then be sure that you're aggressive when we have our discussions. We've tried to design it so that every panel has a good period of 30 minutes at the end of it to take questions and to have discussion. So don't be shy if one of these questions is near and dear to your heart and you really want to put it to the panel and get their sense of it. Because really it's becoming much of a machine world in many areas of finance, and I think that people will have a huge role in that, but the role that you will have will be very different than the roles that there are today. So I stress again that pretty much no matter what area of finance you go into when you start, in 5 years and 10 years, and after that, you'll be doing things that we don't really know what those roles are today. And I think that was true of all of us who are sitting in the room as well. So one question is, how are we going to embrace big data and machine learning? So let me just kick out a question and take a poll, because there's quite a divided opinion on this. How many people think that the whole artificial intelligence and machine learning will actually take hold? I ask that because let me just say that in the 90s, we did a huge push with neural nets and artificial intelligence. And I remember at the time running a quant area at a hedge fund and coming out and trying to work with professors at Caltech to put all kinds of neural nets into our trading systems. And we, like a lot of other people, finally threw up our arms and said, this isn't going to get us anywhere. The question is, this time will it be different? So how many of you think that this time it will be really successful in the financial field? And how many of you are on the other side and think it won't? So there are, and it really is polarized. I mean, people really are at one spectrum or another. So that's part of the debate we should have today, and it sounds like we've got some people on both sides, so that's terrific. What are the new techniques for structured and unstructured data? Let me just say that, again, I'll date myself. When I started on Wall Street, we didn't have computers on the trading floor. I know that's hard to imagine for many people in the room. However, we did not, and we crunched a lot of the numbers by hand, and the way we got data was actually literally sometimes hard copy, delivered once or twice a week, that talked about where the trades were the prior week. And when we did calculations for things like callable bonds, we would price them to the call date or the maturity date. There were not anything about option adjusted spreads. There was no such thing as volatility other than 0 and 1. There's nothing in the middle of those two things. And part of that was just because of the calculation limitations. And I'm putting that out as an extreme example as it sounds today, because I believe we will be there again, but with much quicker pace than we have been. For example, what we did was, after that, as we got storage and it got cheaper and cheaper, we were able with the storage to store more and more data. In the beginning, all we had was price series, and what we had was kind of open, high, low, close. We progressed into having tick data in terms of price and volume data. And frankly, in both academia and in industry, we studied it like crazy. We learned everything there was about price and volume data and studied it, and we started an arms race for speed in terms of high frequency trading. Like if you could put your servers next to the exchange, and if you could send your signals through microwave, you could basically get in front of the trades faster than other people. And much of the trading volume today is dominated by that type of activity. We were not in a position where we were able to study, because of the limitations both of cost and time and calculation speed. We couldn't study unstructured data, and we couldn't study many other types of data that tell you an awful lot about what's going on in the world and potentially the markets and fundamental analysis, right? I mean, for example, when you think about the success that's been had in marketing areas with studying unstructured data, where you can follow, for example, what the chatter is about the latest models of cars, and that actually helps manufacturers know what to produce. It also tells you a lot about what stocks you might want to buy in terms of who's going to be making a lot of sales. And so we have these opportunities now to marry all these new worlds of data. Today, one of the things we'll be happy to hear about is some of the satellite imaging developments that are going on. And you can start to stretch your brain to think about how you might use those data to determine what's going on in certain types of business and which markets you might want to do you're investing in around the world. So we're really at this huge new place that is just as exciting and probably more exciting than when we finally brought the computers onto the trading floor, and then we were able to study more and more data all the time. So that's the exciting part. I think one of the scary parts I'll just put out for all the statisticians in the room and all of our budding financial professionals and financial economists and others is that we have 10 years of data that has been since we had tremendous intervention around the world in the financial markets. And I think there's a lot of very deep questions for those of you who are on the academic side and you're looking for thesis topics. I think there's some really good questions that are there's just a wealth of interesting questions in there. For example, we'll start with a really simple one. What's the actual risk-free rate? Can you actually use the rate that the government borrows anymore as the risk-free rate if it's got so much intervention in it that it's really stepped on so hard? So how should you even think about risk analysis? And you have so much extra liquidity in the markets. It's really impacted supply and demand and price and risk spreads, risk premia. So I think that while you might feel warm and fuzzy when you have a 10-year data series, like, oh boy, I have all this data, you might be studying a state space that really doesn't apply to the world. And so when we get out of this intervention, it's questionable whether we're going to head for some real problems because of that. So how will traditional players transform themselves, and will they collaborate or compete with FinTech? How many think that they will collaborate? And how many think they'll compete and disrupt the FinTechs? So again, we have, it's a similar thing. People tend to be on one stream or the other. Certainly a lot of the big financial firms have started all kinds of innovation labs. They're in Singapore, they're up in Silicon Valley, there's some in Boston and New York now. Those are really exciting places for, I think, early jobs as well. We'll talk a little bit, how will disruptive players have an advantage? Regulatory change and fee pressure is enormous. Institutional investors just are refusing to pay the old fee structures where you take 2% asset management fee and 20% of the performance. That's pushing all this robo-advising and quantitative structuring of portfolios. So this is a huge, interesting area in finance. And then how quickly are we going to get out of date? It's really, for all of you entering the field and the rest of us who are in it, it seems that you have to run faster and faster all the time to stay on top of the advancements. So the what questions, what are our predictions? Where are the hottest trends in quant techniques? Where are the greatest job opportunities? You're going to hear a little bit about that today. What advantages do the disruptive players have? What are the key risks and opportunities? And then which stakeholders are really going to drive the process here? Is it the people who are developing the ideas? Is it the people who are using the ideas? Or is it the people who have the money? And different forces, I think, at different times are important to think about. But I think what we're going to try to do at least is reveal the different ways to think about it as you're picking your jobs. So we'll also put some global focus into this. There's really interesting stuff going on in Asia and India and in the South American and African markets, particularly with respect to blockchain and with respect to operations and payment systems. Those are very exciting areas. And the question is where will be the dominant centers for finance in the next decade and 2 decades, right? I mean, the US and London have been very dominant centers, but nothing lasts forever. And I'll just say, I'll give you a personal opinion. To a certain degree, I think that the US is very successful right now because we're least worst. And I don't know that least worst is a long run winning strategy, but it's keeping our markets very pumped up still. And I think will for a while in here. And then we have the when questions, sort of like, when does all this happen? And, you know, when will, for example, and will it, passive dominate active? So let me take a poll in the room. How many of you think that in 5 years, passive will dominate active investing? See, and that's really important for those of you thinking of going into the field, because many of the jobs that are really, and were really fun jobs, I think when we entered the field, were very much in the research areas. It was, how do I do fundamental analysis, and how do I really help with hardcore qualitative analysis to go alongside the, you know, the quant stuff. In some ways, it was also quantifying the qualitative factors. And I think this is a place where, let's just say, I think the jury's out. I think that on the one hand, I personally, and this is a personal view, I think that the passive has become very popular, partially because of the last 10-year period. The last 10 years has been so intervened and has really not really needed a lot of qualitative fundamental analysis. I think that if we have active again, I think it'll probably be much more technologically levered. So let me just sort of wrap it up and say that, you know, that this whole discussion of mathematical finance really has to be against the global financial landscape. So where are we? We have huge regulation, huge intervention, a lot of unintended consequences of this, you know, the financial bailouts and the intervention. For example, we have much bigger concentration of the big firms. We've had an awful lot of, you know, nationalism coming out of it, less independent central banks. We have a lot of side businesses that are starting. There's a lot of two-party bilateral financing going on that's outside of the normal financial firms now. So that's changing things. I think also an exciting part is new risk return tools for the, you know, the risk managers and statisticians in the room. I mean, we again, because we were very limited in the data we had and the computational techniques, that we're actually able to produce an answer in a trading time period, okay, so fast enough to do a trade, we all sort of lean towards statistics. You know, but statistics, when I want to talk about, like, what's my probability of losing money, right, it's probably not answered well as, for example, what's the probability that there's a hurricane is going to strike New Orleans again, right? I mean, one's kind of more of a random event, whereas the probability of loss is involving intelligent agents. You have intelligent traders, intelligent market players, and, you know, that kind of speaks more to something like game theory. So I think that's a place where if we drew a line in the sand and we look at this wealth of data we have today and the ability to crunch it so much faster, and if we look at what the tools are and the analytics that have come up, and we ask this question of what would we do today, I don't think we'd do what we did. And now the question is how do you get from A to B, right? Because you've invested hundreds of millions of dollars in your systems and in your software and in creating all your reporting and in putting all the accounting around it and all the regulation around it, but it's probably not the right approach. So I think that's a place where we'll see massive change and for the better. I know a couple of you that I talked to who are here as PhD students are studying systemic risk. I think this is a very fruitful area for research and analysis. And then we're going to talk about the changing roles of things. You know, kind of gold was the go-to sort of sanctuary, you know, for fear in the capital markets. But, you know, now you got this growth of all these cryptocurrencies. happening, and that's an interesting thing. You know, if we were sitting here 10 years ago, we would have talked about how the sovereign wealth funds were going to run the world. But then oil went from 100 to 50, and not so much. But you know, that could change. That can change again. Also, one of the things I just wanted to point out is that these are areas that I think also are real wild cards to think about. In the US capital markets, if you want to raise $1 and you're starting a new business, the likelihood is you're going to go to the capital markets and you're going to get someone, whether it's in a private deal or a public deal, to do a stock or a bond investment in your startup or your company. If you're in Europe, 80% of the time you're going to go to a bank. So when you think about the dynamics of markets, those are very different. It probably explains a little bit about why the recovery in Europe has been so much slower than the recovery here, because there was only one game. It was the banks. And if the banks are in trouble, they're just not going to lend. So it's really hard to get money, right? Whereas if you have the capital markets, there's another way out while the banks are recovering. And it certainly helped to make the US least worst, as I explained before. But I think that this is a question for all the emerging markets, is which one of those paths ultimately will we go down? And it's a very interesting area of research to take a look at. And also I think it speaks also to the cyber attack risk. You know, there's a lot of questions right now about if you really wanted to have a war with a country that has, you know, these big capital markets. I mean, do you really need to drop bombs and put boots on the ground, or can you just attack them through the financial market? And so there's a tremendous amount of fascinating research going on in those areas too for people looking for thesis topics. And I just put this last one. I mean, I think, you know, state-space models were very much a trend in the 80s, I think, when we were all looking sort of at systemic risk, and then people kind of threw state spaces out. I think state spaces are going to be important again, only because right now we're living in one that we didn't have before, the intervention state space. And I point that out just again to think about whether or not you can really trust the data. So we have this whole new world, the insurance techs, the alternative finance, the robo-advisors we're going to talk about today, blockchain and Bitcoin. We have reg techs. You know, there's so much regulation. People are trying to automate like crazy. A lot of the monies raised have been in those areas. Digital banks, payment systems, you know, Apple Pay, Google Pay, you know, all over the world. And then machine intelligence. Sorry, this one's kind of hard to read. The list is so big it was hard to get onto one screen, but certainly what we're doing in machine learning and machine intelligence and artificial intelligence and neural nets and deep neural nets is just enormous now. So I would say that the market's really changing. I think we're headed into, you know, what arguably could be the fourth industrial revolution. Instead of going to Amazon and ordering one of the choices that are very reasonably priced because they're made on large-scale manufacturing runs, now that we have a combination of robotics and we have a combination of 3D printing, when you go online soon, what you will do is you'll say, I want one of this size and this color and for this purpose, and it will be immediately manufactured and delivered, maybe even by drone. And the good news is that all those malls that are going out of business and are becoming empty real estate are perfect sites for these close to delivery manufacturing. So I think that those are going to end up being blessings in disguise. But these slides are all posted. These are just examples of all of the new things that are happening in the market that are suggesting life will be very different. And I'll just wrap up by saying that, you know, we're really at a stage of, I think lifelong learning has been the name of the game in finance for some time, but not with the rapidity that you all will face, and that we'll face until we decide to do something else. It's just an enormous undertaking. So I think events like this are terrific because you get to see, you know, a huge breadth of what people are working on both the academic and the practitioner side. I think it's impossible to do it all yourself. So having, you know, networks and being part of organizations like this that can really help you to stay on top of this are are critical for success. And I'm just going to close by saying that this is kind of the theme of the day, is that the only bad questions are the ones that you don't ask, because our hope today and the reason we're here is to try to, pay it forward a little bit and help you with whatever tips we can give you as you enter your careers, whatever those may be. So let me take any questions. I take it everybody knows where the restroom is, which is straight out and to the right. We'll have a nice long lunch break, some networking breaks. Please don't be shy and go around and introduce yourself to all the speakers. Ask your questions, and we'll try to walk around too, but that's really the goal of today, is for us to help you. So let me invite my first panel up.